But it's true. Like, you should not be in a place put where you feel like you've lost freedom, where you have to be put in a one track place. And that's where everybody is being driven into, especially those that aren't financially independent. You don't have those freedoms, and you need to have that freedom there so you can experience greater freedoms that are offered in this country.
All right. Yeah, we're rolling. So I have today, it's my pleasure to welcome Chris Miles, Chris of the Chris Miles Money Show and moneyripples.com. Chris, welcome again, and looking forward to talking today.
Hey, same here, man. Really looking forward to it today.
Yeah, getting tongue tied with excitement. I know we set this up a while ago. I reached out to you because I am, I love your topic. You're sort of anti-establishment, maybe in terms of finance and investment. You do a lot in passive income, which I know that's really resonated with our audience. People love the concept of passive income, their money working for them. And in particular, I reached out to you because you do talk about infinite banking. It's a term I've heard thrown around. I don't understand. I would love to understand more about it and how to harness it. So with that being said, looking forward to this. Could you just fill us in a little bit more about what you do through your podcast and Money Ripples?
Yeah. So we basically teach people to get to the point where you have enough passive income to work because you want to, not because you have to, right? Your work optional. You can keep doing what you love if you love it. If you hate it, great, you can quit, right? Just give you those options to free up that time, free up the ability to be able to do what you want with, and do what you love with those that you love, right? I mean, that's really what we're about, is about creating that freedom and that prosperity now versus waiting until you're pretty much dead to do it the traditional way, right? Which is what every financial advisor encourages you to do. I'll give you an example. I had somebody who just the other day, they said, yeah, this financial advisor said, if you keep this up, you might be able to retire by 65. She's like, well, but I want to retire earlier, younger. And the financial advisor almost proudly said, I got you. We'll do it by 59 and a half. It's like, she's like, no, that's not what I mean by younger. Come on. Like, I want younger, like 40s, 50s. Let's do this. And so that's what we do, right? We actually do that and do it in a way that's safer and much more really proven than anything financial advisors have ever done.
Awesome. Yeah, I love the concept of sort of passive income now or nearer term and lifestyle changes. I know so you and I talked a little bit off air about audience, right? We've got guys that have sort of made their money, maybe they exited a business or exited a career, and traditionally financial advisors sort of have us fixated on the number, right?
Yeah.
What's the nut that we need? But it's a scary world, right? Medical costs, medical insurance alone, if you're not through a corporate plan, but then medical costs, we know you spend the 90% of your medical in the last 10% of your life. It could bankrupt you. We're now starting to admit that we're in a highly inflationary world, right? So all those things don't really make you want to rest on your laurels, but at the same time, you don't want to work forever. I come from a consulting background, and it's oftentimes either it's a massive pyramid scheme, good if you're at the top of the pyramid, or it's a trade time for money sort of scheme, and that's the antithesis of what you're trying to help people achieve in more time and finance freedom. So I guess that being said, it's awesome that I have folks in my audience that are on the younger end of the spectrum and can plan ahead. When we talk about establishing passive income, how long does it take to build something up as income replacement, especially for audience that are maybe 40, 45 into their 50s already?
Yeah, I mean, usually, you start creating passive income within months, right? Now to get to the point where you could say, now I'm work optional. I mean, that could take. Sometimes I've had people, it's a year or two. Other times it's, I'd say typically 5 to 10 years, right? Usually it's not a whole lot longer than that. If you do it right, and that's the thing I tell people. It's not about working harder. And it's definitely not even about working smarter, because there's a lot of people that have researched their brains to death, and still it's elusive, right? It's not about working harder or even smarter. It's about working right, doing the right things, doing it the right way, and getting the right results. And that's what gives you that optimal, max efficiency.
Got it. Okay. Well, let's dig into that a bit. I guess I want to ask about both sides of it as well, in
Yeah.
terms of just not only creating passive income, and let's talk about some of the ways that you like to help people do that, but the other side of it as well. I noticed on your website, you mentioned the concept of helping people address money leaks. Is that the spending side of their lifestyle, or is that related to the income creation?
It could be both. I mean, sometimes the biggest money leak you have is the income you didn't create with it, right? But it can be from the spending side too. It could be from taxes. Are you overpaying on taxes, not knowing it? Which even if you have a CPA, it doesn't mean the CPA is doing their best job. Sometimes I have people like I get like guys like I had a guy from San Diego, just in your neck of the woods, right?
Yep.
I mean, smart guy. I mean, ultimate saver. He's like the Dave Ramsey poster child, right? Where he doesn't he lives a very inexpensive life. He's trying to pay off all his debt, including his last two mortgages, right? He has an investment property in California up north more, and then he's got his house, and that's it. So, I mean, for a Dave Ramsey fan, and he's been packing money away into stock market crap and things like that. And I was like, okay, well, what's your goal? He's like, well, in 6 years, I want to put all this extra money. He's like, I'm saving a little bit, but I'm trying to put all this extra money to pay off these two mortgages. So in 6 years, we'll be debt free. I said, all right, well, what's that going to equate to? He's like, it's about 4,000 a month. I'm like, okay, so that's like 50 grand a year. I'm like, do you realize that because of the equity you already have in these properties, and especially if somebody's in California or Washington, Oregon, anywhere in the Western half of the US, you'll most likely have a lot of equity in the property and little cash flow. And that was his case. He had one property, his investment property that was like their first home. It was their love, right? It cash flows $200 a month, but it has 700,000 of equity in it. Right. I said, if we get you to sell that property, yeah, you'll lose the $200 a month, but that 700,000, we can put it in other properties out east, right? Properties are cash flowing at least 10 or 12% cash on cash returns, which means you're actually getting that money net of a property manager taking out their fees. So even after they take out all their fees, you're still making a 10 or 12% return, not including appreciation and all that other stuff. And so I said, doing that, even if it's just 10%, means you're making 70,000 a year versus 2,400 a year, right? And I was like, remember, in 6 years, this is within 1 year, right? I'm like, remember, in 6 years, you wanted to free up 4,000 a month, but here, that one move alone could actually increase your cash flow by about 70,000 a year. And that doesn't include, we can refi your current property, get some cash out of there, add some more. I said, we can actually get you closer to more like over 80,000 a year in 1 year. By year 5, you'll be over 100,000 a year already, versus almost debt free, trying to free up 4,000 bucks a month, right? And that's the kind of thing that we see all the time. So there's money leaks like that. There's money leaks where somebody's not necessarily spending a lot of money, but again, their money's not being used the most efficient way possible. That doesn't even count like a guy I just talked to recently where he's got like 600,000 sitting in his mutual funds and stuff. He can actually use it because he was a cop, right? So he has access to that money early. But the problem is that it has to be stuck with financial advisors, or he can get it out. He loses that little 10% early penalty. He has to start paying that, if he takes it out, but then he can make as much as he wants. There's things we make at least 10 and 15% a year or more in investments that are outside of the stock market with less risk than the stock market has, right? Where you don't have all the ups and downs. It's more like consistent types of payouts, and in buying in real assets, not zeros and one numbers, that you see with companies. I mean, heck, we saw Facebook drop like 26% in 1 day. I mean, that's just insane, but that's the stuff that people are doing. Like even if you put in the S&P 500, they don't realize it's heavily weighted towards those very companies. So, if you have it in those kind of tech companies and they crash, you're hosed, like you're not diversified like you think you are. You're actually investing in something you have zero control over, financial advisors have zero control over, and you get taxed down the road anyways. Even if it's a 401k or an IRA, you still get taxed, right? That's another money leak, so again, all those things we try to address while also trying to create more passive income.
Yeah, I think that that Facebook blip wiped out like 30 billion in market cap, something crazy like that. Yeah, no, I get it though. Like it's tough, right? In the cycle we've been in, the massive, well, everything bubble, but certainly stock market bubble, and people get this fear of missing out. Like, well, yeah, you get your Facebooks here and there, but the thing just keeps going up and up and up. There's so much cheap money seeking alpha. There's so much support of the equities market politically through the Fed. Well, now we're sitting at 30 trillion in debt here. As a country, we've created 7 trillion in new debt since the pandemic quarantine 2 years ago. I mean, inflation is everywhere, and investment asset prices right along with them. So, it is it's probably a great time to be a financial advisor, traditional financial advisor. Yeah. It's a tough time to walk away from what looks like, a party that wants to keep going. even though people understand, kind of like we understood a decade ago that the real estate was in a bubble. It's like we understand we're in the everything
Mhm.
bubble, but it keeps going up for now. So
Mhm.
what kind of folks do you end up working with? Who's coming to you these days in a market like this? What kind of folks are asking the curious questions that might lead them to discover new opportunities?
Yeah, generally get the people that are saying, "Hey, I think there might be something better out there. Am I really getting it?" Right? Or like you addressed, I mean, there's so many headwinds on the market. I mean, the stock market through 2021 had its 13th up year in a row. Understand that's never happened in history of the stock market, even since the 1800s, right? The closest, the longest streak we ever had of consecutive up years in a row was 6,
Mhm.
and we had 13. I mean, talk about a massive, crazy bubble. And of course, like you said, pumping out all this money, people are like, well, where'd I put it? "Oh, okay, I'll buy crypto or I'll go buy stocks." Like they're just gambling it, right? It's
Yeah.
dumb money. And you never want to be in a place where so much dumb money has entered, right? And that's the stock market right now. I mean, it's so overdue for a crash, you know? And so there's a lot of people that just know that in the back of their mind, they're like, something doesn't feel right. This shouldn't be happening. I'm grateful I made a lot of money, but what am I going to do with it? Right. So they're wondering that. They're like, they might have been pumping money in their 401ks and wondering if they should keep doing that because even with the match, 401k actually doesn't pay that much, unbeknownst to popular belief. Other things too, like some people might be like, "Hey, I've been saving, I've been trying to get out of debt, and yet it feels like I'm still not any closer to freedom. I don't have that actual security or that passive income. What if my job or my business becomes non-essential?" Right? All that kind of crap that we heard in the last couple of years. So there's all these kind of people that are really in a great place. They have at least a few hundred thousand in either like savings, stocks or mutual funds or retirement plans, or even in equity in their homes, right? They say, well, could I be doing something more productive with this where it actually can start to replace my income? So then if any of this stuff happens, I'm safe. Like I know I can take care of my family. I know I can have time with my family. I have all the freedoms that I could possibly enjoy that really, I'll tell you from being a financial advisor 20 years ago, right? I did that for 4 years. I will tell you, it is almost impossible to truly retire well saving the traditional way. Say you're saving $20,000 a year in your 401k, just so you know, even with the match and everything else, you're still going to have, after inflation and the cost of living, type of changes and taxes and everything else, you're still going to be living at about a 20,000 a year lifestyle if you want your money to actually last. Now, if you want to die quickly, live on ramen, basically everything that the show teaches you not to do, if you want to die quickly, you're fine, right? You just eat up your money and then die. But unfortunately, we don't want that for you, right? We actually want you to enjoy your life and live it today, not possibly when you're 60s. I mean, I have a good guy that came to me recently. He said, "Chris, I've got $3 million saved up in the markets now. Like I've been packing money away like crazy for a couple of decades." And yet his financial advisor, he's 52 years old. His financial advisor said, "If you keep going, you'll eventually hit your goal. Maybe you'll be able to do it by 65." Because his goal is to live on a 500,000 a year of income, right? But to do that, to actually do it well, Wall Street Journal came out in October, said you shouldn't even obey the 4% rule. There's a lot of millennials I know that's saying, "Hey, the 4% rule, I'm almost there." No, the 4% rule, even 20 years ago, we questioned it. Like
Mhm.
at most, it should be 3%, which is what the Wall Street Journal just said. So think of this. If you wanted to live on 3% and have 500,000 a year, right? That means that you got to have at least, and in his case, by that time he was talking about his goal, he's got to have at least about $15 million saved up. So
Right.
he's got to go from like 3 million to 15 million the next 12, 13 years, right? That's just insane. Where I told him, it's like, listen, you have $3 million. We can turn this into at least 300 to 350,000 of passive income this year, right? This year alone. And if you reinvest that money, then that just gets added on top of it. That turns into another 30,000 plus a year. I mean, he already would be financially independent in year one, but to hit his real financial freedom goal of 500,000 a year, we could do that within 3 to 5 years, So that's the fun thing that I love doing.
Yeah, that's pretty incredible. I guess I would add to maybe the call for people who are looking for a reason, or what type of people could or should be looking for a different approach, or maybe a secondary approach.
Mhm.
Um, so I've just run into and have friends, whether it's educators, military, medical field,
Yeah.
who the last 2 years, or the last year in particular, has really hit them in some pretty demanding ways. Whether it's exhausted by work, and all the requirements going along with it. Or, one friend who is right up on his 20 years in the military and invested those 20 years because of something he believed in passionately,
Mhm.
and is not interested in getting vaccinated himself, but now
I was
he's
just
he's
gonna
got a
say that.
choice,
Yep.
right? Do I do something I'm not, it's not my personal choice medically, versus what I've invested in and I believed in so heavily, and may or may not have, the financial avenue to make a different choice, right? May feel penned in
Yeah.
financially.
I was
So
actually, it's funny you said that because I was just at the gym this week, and I was running on the treadmill, and I saw, like, how they're saying the deadline, even here in Utah, right? The deadline's coming up for many servicemen, as well as, people in police and things like that, that if they don't get the jab in the next few months, they're fired,
right,
right? Which we never thought they would do, but they've already started to do it. I mean,
right,
these are people that were the essential people. Even nurses and doctors were essential in 2020. Now they're becoming non-essential in 2022. That to me, like, just pissed me off, because I'm like, listen, like, these are the very people that need to get passive income coming in right now to make sure that they can say, screw you, like, I'm out of here. Like, I don't care if you try to take my pension away. I'm not going to violate my values and my freedoms just so that you guys can enforce your own regime, right?
right.
And I think that's kind of strong words, I know, because but it's true. Like, you should not be in a place put where you feel like you've lost freedom, where you have to be put in a one track place. And that's where everybody is being driven into, especially those that aren't financially independent. You don't have those freedoms, and you need to have that freedom there so you can experience greater freedoms that are offered in this country.
Yeah, no, I know we're getting on the soapbox here, and we could spend a whole bunch of time on this. I mean, I'm of the opinion that consumers have long memories, and maybe marketers don't believe that. Maybe corporations, a lot of them don't believe it, or maybe they do, right? Because so much money does go into marketing messages. But I look at, like, Apple and other companies that were firing off employees that decided that between them and their families and their doctors that they weren't going to get vaccinated.
Mhm.
And these companies were firing workers even before it was decided through the federal court system whether that was or wasn't a legitimate mandate, executive order mandate. Um, and then, right, the thing goes, no, it's not a legal mandate, and these guys are hiring people back now. Like, we're supposed to just pretend it's all okay, or, how should I look at
Uh-huh.
that brand in the future? Now I understand that brand's sort of true colors, um,
Mhm.
and maybe it aligns to some people and it doesn't align to me, and well, that sticks with me. So yeah, I'm all about kind of creating sovereignty in our lives, and certainly finance is a huge way we need to do that. Question about, let's talk about how some of this stuff works, but also you mentioned tax. So I'm just looking at my
Mhm.
notes here, and I think, as you mentioned, there are better alternatives than plowing money into 401k plans or other qualified or tax advantage plans, even along with or counting the match. But much like mortgage interest, with
Mhm.
401k or qualified plan contributions, we get hooked on this idea. Well, there's been this incentive created through the tax system. So what's kind of are there tax advantaged things that you like to pursue that are alternatives to throwing your money into a 401k, or is it more that on net you're better off anyway?
Oh, absolutely. Well, and it's funny about the tax advantage system, right? Because people say, like, oh, there's tax advantages to 401k. No, it's just tax delays.
Hmm.
They're just taxing you later. Which, do you really trust that the tax system is going to get better than it was from the Trump tax plan? I mean, sorry, but I mean, that was already super low. I thought it was low before Trump, and then it went lower. I thought, oh my goodness, this is awesome, right? I still think it's too high, but I mean, the truth is, it's probably going to go higher. So, are we really saving on taxes, or are they just delaying it, banking on the fact that we're going to have to pay more? And if they drive up inflation much more, for cost of living, you have to pull out more, putting you in a higher tax bracket, even if they don't change the bracket. But all of a sudden now, like, middle class, you have to pull out 100,000 a year. Like, oh, guess what? Higher tax bracket, right? So when somebody says, like, oh, I get tax advantages, no, you don't. Well, I can do a Roth conversion. I can convert that to a Roth. You still have to pay taxes on it. And even then, they've even threatened to start taxing Roths for certain people that have too much in those Roths, right? If you're too rich, hey, you can't have a Roth anymore, or you got to get taxed. So there's all this stuff that, again, it's government control, right? And you, like I said, you want to be sovereign. The places you can do that, and this is the thing, you want to follow where politicians are getting, where they have their money. Because most politicians, I mean, even though they've sort of shed light on the news about, them trading stocks and stuff, the truth is that, I mean, even Pelosi, who's got a decent amount of stocks, that's a small percentage of her net worth. Most of it's in business and real estate, right? They actually own a vineyard out in California, right? They own that. They've got lots of commercial buildings and things like that. Do you really think that even Pelosi, who would love to tax the crap out of the rich, and they are worth at least 104 million as of last year, more of the verified number, right? Would they really want to tax themselves more? Of course not. No, they're not going to do that. So business and real estate are some of the best places. So what does that mean? Like with real estate, I buy a property. I can buy a property with as little as like about $30,000 down as a down payment, right? But every bit I get, because it's coming in as net profit, and I can make a lot of profit on that. Usually I make at least 300, 400 bucks a month off that, right? That's net profit. But because I can depreciate the property, I don't get taxed squat. Yeah. So I show, if anything, I can even show a loss if I wanted to, but I'm really taking that tax-free income. Plus it grows, I mean, this last year or so, right? The last few years have been awesome. I bought a property in Memphis 4 years ago that's already given me over 300% return in 4 years, if you include some of the equity, right? Because now a few 100% of that was equity, but about 100% of that last 4 years was the cash flow and them paying down my mortgage for me, right? That's all awesome. And then I can move that tax-free into another property and not pay taxes on that. You don't get that benefit with a 401k or an IRA. You can't just move it over tax-free, because eventually when you take that money out, it's taxed, right? You don't have that problem with rental real estate. And you can do that and you don't have to buy a property or own a property, even though that's a great way to go. There's syndications, right? There's things where you can pool money together with other people to buy into an apartment complex. Or two, if you're worried about recession, one of my favorites to talk about with recessions is self-storage, right? There's self-storage units you do that are very profitable, and they can make at least 10, 15, 20% average per year. There's even mineral rights and oil, things like that. You get tax benefits on oil. I've got one investment where they pay us between 10 and 15% a year, on that. And that's actually cash flow, not just, growth, right? That's actually money coming in your pocket. So there's so many things you do. You can do lots of things in various things. You can diversify among real estate, oil, things like that. Even in business, you can buy franchises and do things there too. I have clients that say, hey, I want a part-time franchise where I can stay out of it like 5-10 hours a week managing it, but it pays me 6 figures, right? There's things you can do all over the place. And by the way, if you have IRA money, you can actually use it in places like oil or into certain types of real estate, or even buying a franchise. You actually can use an IRA to invest in a franchise and be able to pass along those tax benefits that way instead. So there's lots of different options you can go.
Yeah, not always an either or. And of course, real estate, for the most part, has the advantage of leverage, right? A lot of lending opportunities and tax opportunities. What I guess the one thing that always kind of sticks with me today around real estate is it's part of the everything bubble, right? Real estate's gotten pretty ridiculous, and certainly in San Diego, a lot of parts of the country as well. So are you still looking domestically? Do you look at real estate and other things internationally as well?
I don't look international, because the truth is most people internationally are looking to here to buy real estate. Because like I have clients in Australia, for example, they're saying I'd be lucky to make 3% a year on my rental properties because of all the the different ways that their mortgages work and things like that. Even in Canada, it's not great. But here in the US, there's still a lot of great places. And you're right, West Coast, really Western half of the United States, overbought, right? Like the prices have gone up and the rents have not gone up in the same proportion. So whenever I get somebody in the Western half of the United States, they're always like, don't you think it's a little bit too high priced? I'm like, yeah, but have you looked out east? Have you looked in like Oklahoma, Missouri, Tennessee, the Carolinas? Have you looked out there? Alabama, right? You can buy amazing properties that would cost us double, triple the price out here, right? And their rents aren't much different, so that's why it's so easy for me to make at least a 11, 12% cash on cash return on a property, even after I pay a property manager to do it for me. So I never invest in my backyard. I don't like, here in Utah, don't like anything. Even when I get people in Utah, like, I want to buy a rental property. I'm like, why? It's so much better to buy it away from you. And you don't get emotionally attached, because you don't walk through it and say, oh, you see the potential of this place? Like, no, I have to look at the data and make sure it's the right thing, and of course, if they have connections out in those other markets, they just send you properties, say, hey, here's some ones we've already vetted for you. What do you think? It makes it totally easy. So You're right. Like California, I think specifically is an issue because if we start seeing interest rates climb a lot,
Hmm.
that will, I mean, even in end of 2019, we were saying the prediction was if interest rates went up to 5% on the mortgage rates, California would drop 10% in values. That didn't happen, right? It ended up doing the opposite in 2020. But that could still happen in California. But overall in the country, the truth is that this is not 2007, 2008. This is not the same recession, right? This is not the same conditions. We don't have overbuilding happening right now. If anything, we've underbuilt. We have lack of supply, plenty of demand, and there's not enough. And so that's going to keep driving prices up or driving people into other places where the prices might be lower, which I don't mind because that means my property values go up. Rents go up as a result too, because if there's less properties available, it means there's less rentals available, and that just drives it up. And even if there's a recession, I don't buy super expensive properties. I don't buy big mansions. So if people have to downsize, great, they downsize in my property, and then I drive the rents up. Yeah. So either way, like I feel like I'm probably one of the safest places to be inside of real estate because we put these certain parameters in place to make sure you're already accounting for possible scenarios. That's why, again, I don't buy on the western half of the US. I look out east where people really are moving right now.
Yeah, no, I'm all about the arbitrage, and that's good to know. Certainly haven't looked back east in quite a while.
Mhm.
So I appreciate that. I'll take a look at it. I'm just going to mention to you on, yeah, certainly, if the cheap money train ends, it's going to impact some of these most expensive markets first. I mean, there's just no way around it because you look around, you go, what is going on with these prices? Where are the buyers coming from? Where's the lending
Oh
coming
yeah.
from? Where's the money coming from?
Mhm.
San Diego is a pretty sort of cross-border international community, and some of the
Yeah.
West Coast is as well. Same deal in
Yeah.
Australia, right?
Phoenix.
Australia's had a ton of Chinese money.
Yep.
West coast of the or western part of the U.S., we get a lot of international money as well, but it's
Absolutely.
out there. And yeah, if we start hiking rates up to deal with inflation and mortgage rates go up along with them,
Mhm.
it's certainly gonna put a damper on that.
For
I
sure.
was gonna mention to you and to the audience, I've got a bit of an econ background. I had an econ professor that's gone back to the fund world. He was a commodities guy originally named John Hussman Funds, and he's got a newsletter. It's free monthly newsletter on his website. Check it out if you've never come across him or read through his stuff. He's probably one of the smartest guys I've ever met. He's super deep on data econometrics. And so if you really want to dig into this email or to this newsletter, it will have like pages and pages of mind-blowing analyses and data and all that kind of stuff. But you can also just read sort of his intro paragraph and his conclusion paragraph. He's a very, very data-driven guy. He's done backwards analysis on all of his modeling across every cycle, and we all know this, right? We know that life is cyclical. Everything goes in cycles, and we know we're well past extended historically on this equity markets cycle. And I think we all intuitively know that there's sort of a reversion to mean, right? There's an average, there's a trend, and we may overshoot it or undershoot it. We always kind of come back to the trend, whether it's trending up, trending down, right? We always kind of come back to that average. And I mean, his numbers are freaking scary, Chris. They're like, he
Mhm.
goes, if we're just going to return to that norm, right? Reversion to mean, we could be looking at a 60 to 80% drop in stocks just to get back
Oh yeah.
to normal, right? That's
Just going back to the normal
if we don't
PE
overshoot
ratios.
to the downside, right? So it
Yeah.
could even be worse than that. And then if you look at it from like a 10-year expected rate of return or return on S&P, it's negative by his
Mhm.
calculations, right? So, and that's
Oh
before
yeah.
inflation.
You draw
Uh,
that long-term trend line. Like, I used to teach people how to trade stocks and options. That's the ironic thing, right? I even taught people how to do that stuff. You look at the long-term trend line of the S&P, it's not supposed to be much higher than about 1800 right now,
mm,
currently. Now, it never just drops down right to that point. So it's
right,
it's going up while it comes in and meets in the middle. But imagine what would have happened if the S&P went down to 2000, which is about what you're saying, right?
right,
It
right.
eventually meets that 2000 before it finally starts to recover.
Mhm.
Man, like, can you imagine how much money would be lost for the average American? And remember, the baby boomers are right at retirement now.
That's right.
They're at retirement age. They're going to start pulling money out. So when they start pulling, if they start panicking, then you're going to see massive, massive crashes in the markets that you've never seen. And people are going to say, oh, I was almost there. Or those, especially the millennial generation, those are like in their 30s right now saying, I was at that 4% rule. I was financially independent, retire early, fire, right? Those people are going to say, oh crap, I'm nowhere close anymore. I'll just have to keep saving. And that's
Yeah.
exactly the trap that everybody gets caught into, following the same old crappy financial advice that they've been given.
Yeah. No, if I think back on it, I came into the 401k, the working corporate world, peel it off and invest it mid 90s. And so I went through a cycle and, just look at like a chart of the S&P, right? It was going
Mm-hmm.
up, it was going up. I was throwing money in, and then we had a crash. And I was like literally back to where I started. Right. And
Yeah.
then I went through another one of those, I suppose, .com,
Mm-hmm.
and boom, like right back to where I started, like two bubbles and busts. And I was
Uh-huh.
flat. It's like, what am I doing? Oh, and now we're in still in the upswing of another bubble, which looks nice until it doesn't, right? And then maybe we're back to that
Mm-hmm.
same trend line that you're talking about. So in terms of
Exactly.
alternatives, we talked a little bit about, we talked about real estate. We talked about thinking critically and a little different than the default mechanism of just taking your
Mm-hmm.
401k deduction, your match, and putting it into that. Um, but you mentioned money leaks in terms of almost opportunity costs, right? Sort of missed opportunities, or where is other money we could put to work. And so I want to ask about infinite banking and
Yeah.
what is that? What does it mean? What does it harness? How does it work? Um, when I hear it, I got to be honest. Usually, I hear it attached to utilizing something like a fully funded or overfunded whole life insurance plan, which starts, raising yellow flags and alarm bells of like, what kind of scheme are we talking about here? So
Mm-hmm.
back me up and educate me a little bit. What's infinite banking? How is it a positive thing? How can we use it?
Yeah, I'll tell you. I mean, most of the stuff you see out there about infinite banking, yeah, although fundamentally it's correct, it's kind of crap, right? Because here's the thing, like I've been financially independent twice, right? I was financially independent in 2006 after I quit being a financial advisor and did things the opposite way, right?
Mm.
Then the recession kicked my butt, especially because I started cutting off streams of income and I got egotistical, thinking as a 28-year-old, 29-year-old, oh, I'm perfect, and then my ego got smashed, kind of like Garrett White, like him and I were actually working at the same company at the same time at that point. We both got our butts handed to us, and then had to recover from that. I had to I didn't file for bankruptcy, but I had to dig out of over $1 million debt hole to then become financially independent the second time at the end of 2016. So I was 39, right? So when I say I was financially independent twice, that's not a way to brag, here's the good news is that I've seen what it takes to work. And what you see most time when you hear about infinite banking, which it's true, like you're using life insurance to do that. It's primarily needs to be whole life insurance if you're going to do it correctly. There's a lot of people out there. There's a new movement of using index universal life, which does not work the same way and has increasing costs, doesn't give you the same kind of leverage. And even banks don't want to lend against it, which is why it's more of a marketing scheme when you hear about index universal life and that kind of stuff. Whole life, if you don't know what that is, it's, you know what term life insurance is. It's just buying death insurance, right? It's like getting car insurance. You only use it if you actually have to use it. Life insurance, term life insurance is that way. Whole life or all these other life insurance policies also have that component where you can build up tax-free savings like a Roth IRA. The difference, though, is that you don't have all these limitations like you do with a Roth IRA, where if you make too much money, you can't contribute, or you can only put in 6,000 or 7,000 bucks a year, right? You don't have any of those kind of limitations. But here's the problem. Most people talk about infinite banking as making this long-term thing where you get to use it as a supplemental retirement. That to me is bullcrap, because these guys aren't financially independent. They're just insurance salesmen, right? They're just trying to sell you crap. Okay. So don't buy into that kind of stuff when we're talking about infinite banking. That's why I had to distinguish mine as being max ROI, infinite banking, right? There are ways to design whole life to be better than even a universal life, and even better than most whole life, where you pay very little in insurance costs, but you're able to stuff a lot of money in. And so I'll get people that are saying like, hey, I want to put in 10,000, 20, 25, 50, 100, 500,000 a year that they can contribute to these plans, right? And when they put money in these plans, very little comes out in insurance costs. But the cool thing is the money is now available to invest, right? So think of it kind of like a Roth IRA mixed with like a home equity line of credit. It's like a tax-free supercharged savings account, right? All in one, right? It's like a tribrid. because what you can do is this, is that, say, for example, you want to put in 50,000 a year into this plan, right? Now you put in 50,000 year one, about 10,000 is going to come out in cost, at least if it's designed properly. Most of the time, if you try to do whole life the way that I don't recommend and why people rip on it, like Dave Ramsey's even, is they're going to say no, because you put in 50,000, all of it goes in insurance costs. And in a normal whole life plan, that is 100% correct. Like if you buy the normal whole life plan, you'll see almost all that go to cost the first 2 years. So if you put in 50,000 a year for 2 years, like I got zero, maybe a couple $1,000 after paying 100 grand. This plan sucks, right? You don't want that. You want it to where you actually have like 85+% of your money available after 2 years, And then by the way, it's already paying for itself by year 3. By year 5, you have more in there than what you've paid into it. That's how it should be set up, right? So what happens is that now this money you put in, so you put in 50,000, you got 40,000 in there. You can now get a line of credit against it, either from the insurance company or from a bank. Now you might say, well, why would I get a line of credit? Because I could just put this money in savings and then invest it.
Right.
Well, guess what? We're doing the same strategy, but what we're doing differently though, is we're getting this line of credit against it, because we get this line of credit. We can get a line of credit as low as 3%. But guess what? When you get a line of credit versus just cashing out, see, if you cash something out, now your money's not making money in that savings account or that place, right? You're just making money in that investment. Well, what we're doing is we're making money in 2 places at the same time, because you'll have your money in the life insurance. Say that you've got, you have 40,000 there, you borrow 25. Well, guess what? Even though you pull out 25 or 30,000 or whatever, all 40,000 is still earning tax-free compound interest, which by the way, in almost every state is 100% protected from lawsuits and creditors. They can't touch it. Although they can get to your IRAs pretty easily, they can get to savings accounts and everything else. They cannot touch this money. So you get a line of credit against it. So the insurance company or the bank will give you a line of credit saying, hey, it's already in here. It's like a collateralized loan. We'll go ahead and let you take that money out for any reason. So you don't even have to have good credit, by the way. You take that money out and then you go and invest it. So you make money over here anyways, and you make money over here too. It's compounding tax-free interest. So say they're paying you 5%, you got a loan for 3%. You just made, it's really not just 2%, right? Because we already know that's more like a 67% rate of return on that interest you're paying, and you're making money over on that investment at the same time. So what happens is somebody's making, 12% on investment property. Now they're making like 14, 15+% a year because they use their life insurance instead of their savings account. So that's basically how it works. I know it's much easier to do with visuals, right? But I mean, that's really what it is. It's about getting double dip on your money, right? It's about using that arbitrage, like you said, right? Where you're able to get your money here, doing what the bank does, which is where they borrow money from you, but then they loan it out and make a higher interest rate somewhere else. We're doing the same thing, just like a home equity line of credit. You use a home equity line of credit, go invest in real estate. But think of this like a home equity line of credit that actually pays you interest and versus just you pay them interest, right? That's the huge thing about it. So actually, if it's designed properly, you make way, way more money than you would just using your typical checking or savings account.
I gotcha. Okay, that makes sense. Thank you for that. So 2 key things I took away there that maybe I didn't realize were that entire principal or net amount that you've got there invested, even though you've loaned against it or borrowed against it, its entire amount is still earning a rate of return, the 40,000 in your example.
That's right.
And of course, I'm gonna pay something like your example, 3% to borrow against that, but then I'm getting an additional rate of return on real estate or wherever that's going. So thank you for that. And then I guess the other thing I took away there was you sort of keyed in on what I was alluding to is every time I hear something that's like blah blah blah, this is the reason you should buy life insurance. It just sounds like a scheme to buy life insurance because they get hit so heavy up front the first few years with effectively sales fees or advisor fees, right? So it's like, are you really in the business of helping me make money, or are you just in the business of selling life insurance? Because that's what it sounds like. And so I appreciate that guideline. I think what I took away there was that if it's structured properly, I shouldn't give up more than, I think you said 15% or so in those first 2 years.
About 20% the first year. And then, like it's about 11 or 12% the second year. And then it pays for itself by the third usually. Yeah. I mean, everything can vary. I mean, if you're overweight, you're in bad health, or you're like 70 years old, this may not be the strategy to use. Or if you're paycheck to paycheck, don't use the strategy, right? But if you're already putting extra money away, even into 401ks or other plans, but you say, but could I take that money instead make passive income with it versus locking it up in my company? I can't touch it. Yes, you can. You can do way better things with it. And the whole reason actually I came out of retirement in 2017, right? Because I'd already become financially independent. I was just chilling. I actually was spending time in San Diego for a couple of months, just snowbirding, escape the Utah winter. And then there was a client that came to me, a friend that was a podcaster. And he said, Chris, I need you to teach my people. I have a lot of doctors and dentists and people like that follow me. I need you to teach my people how this thing works, because the way you design it's way differently than all those other guys. Right. And I was like, I'm kind of done with that. I don't want to be an insurance guy. I don't want to do that kind of stuff. But finally, after he persisted for about 4 or 5 months, kept convincing me, I finally said, all right, if it doesn't take more than 5 or 10 hours a week, I'll do it. And the thing is, like, it pissed me off. I mean, the whole reason I'm not retired right now. I mean, if you've been there, you get it, right? Because when you're financially independent, you start to ask yourself, well, what do I really want to do with my time? And you start to become more mission driven anyways. And the whole reason I'm out of retirement is because I'm pissed. Like, I'm pissed that there's financial advisors teaching you crappy stuff out there that's not helping you become financially free in the next 5 or 10 years. And I'm pissed that there's even insurance agents out there basically trying to figure out, like, they're not financially free. And so they have this tug of war about their own self-interest of, well, hey, if I design it this way, I make a little bit more commission. Hey, they still win. They still get something good, but it's not the best, but they get something good. Right. And that drives me nuts. Even they could do it better. They just don't. And that's what drove me out, and, of course I hire other people to do that stuff for me. So that's not just me, but I mean, the funny thing is, I mean, you mentioned, like, those guys are trying to make money. I mean, there's one company I made in the top 30 of that company out of thousands of agents. And I was doing it 10, 15 hours a week, and the funny thing is, I was minimizing the fees as low as you can possibly go, like, while keeping it tax free. And people, because of that reason, that's the secret, is that when you have that abundant mentality, then people are like, well, hey, I'm making more money in this thing, I'm going to put more in. So the funny thing is, all these guys are like trying to, like, screw people over. People are doing these tiny little policies, and yeah, they get paid 100% on those tiny little policies, or a good chunk. But for me, I'm getting paid like a tiny percentage, but they're doing these bigger policies. And so I was making more money than guys working overtime in this industry. And that's the way it should be. I want to destroy traditional financial advising, the way it's being done. I want to destroy the way insurance agents have been doing things, so that they can actually start working the self-interest of you guys, right? So that you guys actually get the best possible bang for your buck, and you actually we all prosper together, versus this scarcity, you lose, I win type of world that people keep thinking we're a part of.
Yeah, 100%. I appreciate that abundance mentality so much, and appreciate the mission you're on, and I appreciate that you've had your own ups and downs, right? I've been on a similar path. I call it the real life MBA. You pay the price of that failure, and there's a lot of lessons that come with it, and going through those cycles in our own lives. So Chris, want to wrap up here and be respectful of your time. So on that note of the mission you're on, and coming out of retirement to help people with exactly what you just described, how are you working with people? Where do people find you? What sort of clients do you take on, or who's the perfect person to reach out to you?
Yeah, I mean, we do the two things we talked about today, right? I mean, one, those infinite banking policies, how to design them, with the max ROI possible. We do that. And then we also do, like, actual consulting. We're not investment advisors, but we do help you strategize and then connect you with deals, so you can actually create, that passive income, so you can retire now. You get that actual guidance and say, hey, how do I get there as quickly and safely as we can? And so we actually help you map out a game plan and consult you and guide you along that path to find the right deals, and know what the right things to do, versus all the shiny objects, all the possibilities that are out there. How we narrow it down that you find just the best deals. And so consulting and max ROI infinite banking is what we do. And best way, if you want to know about either of those, is just reach out to us on the contact us page at moneyripples.com. Plus, we got several videos and other things you can learn from that as well.
Awesome. Okay. So on the max ROI infinite banking side, you are helping people structure strategies there, and you're actually able to help them execute on a whole life based infinite banking strategy.
Yep.
Okay. And then on the other side, you're not a financial advisor currently, but you are a consultant. You're not syndicating or structuring real estate deals yourself, but you've got
Exactly.
consulting strategies around that.
Exactly. Because obviously, if we were, like, had our own investment deal, like, oh yeah, of course you're trying to do that because you just want to drive our money into your deal.
Yeah.
No, we stay away from all those deals, but we have connections with lots of people that have been paying people for decades, and even through recessions, still kept paying people, 10, 12+% a year on their deals, right? again, nothing's guaranteed, but to be able to say, hey, let's map out a way that get this anti-financial plan in place versus the traditional financial crap that they've been trying to sell you. Let's get something actually in place that creates real results now.
Awesome. I appreciate that. Moneyripples.com. Of course, we'll get links up to that and your podcast as well. I got to check it out, Chris. And I want to say thank you. You know, I have these conversations and I treat them for myself with curiosity and interest in what you're doing and how you're helping people and how it might apply for me. And I hope it resonates with folks in the audience. And in some sense, you know, you podcast, it's a one-way sort of broadcast. And sometimes
Yeah.
you never really know. But I don't know if you have this experience. I'll have people reach out from time to time and they go, wow, you know, that podcast that you had with Chris really resonated with me. And they jumped into something, right? They took action, they learned something new, they made a new move, new investment, it's paying off for them. And so I've had, as I said, I think the passive cash flow topic really interests our audience. I've had people reach out to me about past guests and topics we had around that. And did exactly that, made some new moves, and we're super happy to have met the guest and their topic and the information. So hopefully this one strikes a similar chord, Chris. I really appreciate what you shared with us today and appreciate your time.
Yeah. Really appreciate being here, Michael.
Fantastic. Chris Miles, the Chris Miles Money Show, moneyripples.com. Thank you again, Chris.
Thanks.